Welcome to Lecture 1 of Part 2 of Eggtimer Economics. This is the Corbonomics section. Corporation tax. Labour Party policy at the time of the 2017 general election was to reverse the Tory corporation tax cuts. Our new settlement with business will ask large corporations to pay a little more, while still keeping corporation tax among the lowest of the major developed economies. In turn, we will meet the business needs of a more skilled workforce with extra corporate tax revenues while contributing to education and skills budgets. That's from the Labour Manifesto. The problem is that the economy and business do not remain static while politicians fiddle with the tax rates. People and companies react to changes, and the bigger the change is, the more they react. A 9% increase in tax rates, therefore, is highly unlikely to raise 9 times as much as a 1% increase. What is increasingly well evidenced is that higher tax rates generally result in lower than expected revenues. When tax rates are increased, the return on investment is reduced, so there will be less investment and therefore less growth. If investors and entrepreneurs see less of the rewards, there will be fewer new businesses starting up, less investment in expanding existing businesses, and fewer international businesses deciding to locate in the UK. If this is difficult to quantify, then we need at least to get an idea. In order to do that, we can look at the time when corporation tax was last at the 26% proposed by Labour. That was in 2011-2012, and the tax at that level raised around £41 billion. Add on inflation, that'd be around £44.5 billion today. However, in fact, with the rate cut to 20%, the tax revenues have now soared to almost £50 billion a year. Who bears the pain of corporation tax? People. People rather than companies suffer the burden of corporation tax. Either the company has less wealth, so the shareholder bears the burden, or the company increases its prices to keep its after-tax income the same, so the consumer suffers. Or wages are reduced, staff are laid off and new staff are not hired to cut costs and maintain the same after-tax income. So the workforce bears the pain. However, in an open, free economy, there's usually not much scope to increase prices. The business will become uncompetitive. And if shareholders see too much of a cut in their returns, they will invest elsewhere. That means that the main pain of increasing the corporation tax rate falls on the workforce, as the company seeks to cut costs to maintain its after-tax profits. And not just the company's employees that lose out. Some of the main losers are young people trying to find their first jobs, only to discover that few companies are hiring because they've cut back on their expansion plans in the face of higher taxes. As tax rates are increased and companies invest less because the after-tax rewards are lower, two things happen. Company profits are lower, so there's less to tax. And also there are fewer jobs, and those that remain are less well paid. The effect then is potentially disastrous for the Treasury. Lower company profits to tax and less employment taxation. For small companies, the case is that it makes no sense at all to have a corporation tax rate below the basic rate of income tax. All that becomes is a blatant invitation to avoid tax. There is no evidence at all that cutting the rate has brought jobs, growth, or new corporation tax revenues to the UK. The rise in revenues is very largely because of the rise in the number of small companies and broad-based recovery in profits from banking and elsewhere, and not because of new inward investment driven by tax. We know business has taxes low in its considerations when real business is being relocated as opposed to profits being relocated, which is the type of abusive activity Ireland attracts and which has rendered its national accounting meaningless because so much of its GDP is profit simply flowing through the place, leaving almost not a trace, bar some fees for bankers, lawyers and accountants on the way. Low tax rates and low capital allowance rates are counterproductive and rarely help anyone but banks. You might like to consider why. Post answers in the forum.